So Richard, thank you so much for your time. You're an estate planning attorney, of course, here in Scottsdale. And I'll give you a second, if you don't mind, just to introduce yourself and tell us, what you do in your law firm.
Yeah, sure. Thanks, Armando. So my name is Richard Keyt. I've been practicing law now for about 10 years. Before that, I had worked as a CPA at an accounting firm here in Arizona doing federal income taxes for businesses and individuals. And since then, I've been practicing law with my dad. We do a lot of estate planning, entity formation, and then advise our clients as they run and operate their business on a daily basis.
Yeah, good. Well, I'm glad that we have some time this afternoon just to have a conversation. And what the conversation will be about really is that business owner who maybe hasn't kept their estate documents up to date. They come see you, they've had this business for 20 years. Now the business is worth millions of dollars and they're realizing that they're over age 50. They need to update the estate documents. They don't know what they don't know. They've been so busy working in their business. So when you get that kind of person in front of you who is now saying, okay, estate attorney, help me, what are some of the common things that you see and that you talk about and address for them in that first conversation?
Yeah, sure. Well, the first thing that we want to do is make sure and research how they have their business organized and structured. So do they have an incorporated entity such as an LLC or a corporation? So is there a legal form to the business, or are they operating as a sole proprietorship? And in the sole proprietorship context, that doesn't provide that person with any sort of asset protection. So that's just the real first item that we would look at, because we want to make sure that if there is something that goes wrong with that business, that their personal assets that they have saved and invested into up to that point remain protected. So if it turns out that there is no legal organization or structure, then we want to advise them and help them set that up so that their personal assets are protected. And typically the entity of choice that we would recommend to that person would be an LLC. That's the ideal entity in today's day and age. It provides the owner with the greatest level of asset protection with respect to the business and their personal assets. And then it also gives them the flexibility to choose how that entity is taxed.
And Rick, explain the importance of asset protection, if you would. How, if that isn't the way it should be, what's the potential harm to the family or the business owner?
So the potential harm could be that if a lawsuit is involved with that business, then if there is no legal organization to that business and it's operated as a sole proprietorship, meaning that the owner owns everything, they have title to all the assets, they're doing everything on a daily basis, then whatever other assets that particular person has, and it doesn't need to be a business asset, it could be their personal residence, their personal checking account, those assets are liable in that potential lawsuit. So if you're talking about somebody with a very successful business, there could be an employee issue, there could be an issue with the customer, a contract related issue. So, you name it, there could be potential liability there that needs to be protected from the owner's separate and personal assets, and not just, and just the liability protection related to the business assets.
So if there's a problem in the business and there's a lawsuit, that lawsuit could spill over into all the family assets, the personal residence, any investments they have, any rental properties, it could spill over into that, right?
That's correct. Yep.
Okay. So you mentioned LLC and asset protection. Many people have rental properties, one or two, that they just kind of start way back when, and they forget all about it except for the monthly rent that comes in. The asset protection entity Could you speak about that in terms of the rental property as well?
Yeah, with the rental property, it's the same concept. So if the rental property is owned by that particular person and they have title in their own name and not in an LLC, then if issue happens with respect to that particular rental property, again, their personal assets are not at risk. And, it makes me think of this example of a client that we had a number of years ago who actually did own the rental property in an LLC, but the tenant had a party at this particular house. And during the course of that party, somebody was killed in a fight of some sort. And she was named as a defendant in that lawsuit. But because the property was owned in her LLC, she was easily able to get herself dismissed from the lawsuit. And afterwards, the LLC remained as a sole defendant. And her personal assets then weren't at risk.
So the landlord, the owner of that rental house, was named in the lawsuit where that person died in her home?
Yep.
Oh.
Yep. So that's why it's important to have the LLC there, because if the LLC didn't exist, then everything she owned is now potentially at risk in that particular lawsuit.
Okay, yeah, that could be severe. That could be severe. People get so busy working day to day that they sometimes forget to do those things that they need to, but that's part of why we're doing this conversation, is people will hear and think of themselves and take action to protect themselves. So what about estate planning, Richard, with the overall estate planning, and there are estate taxes and there are families and marriages and second marriages and kids and stepkids, all of that. If the documents are not in line when someone unexpectedly passes, what happens?
So the state of that particular individual has an estate plan if that person were to die. And most commonly, the assets would be left to the surviving spouse if they're married. And then if they are married, but they have kids outside of the marriage, then those assets would be split between the surviving spouse and the kids that are unrelated to the surviving spouse. So that's a very common scenario that actually does happen quite a bit. You'll have a spouse that passes away that owns some property as their separate property, and maybe they have kids that have been estranged for a number of years that they hadn't had any contact with, but at the same time, they never did an estate plan to provide that they want their surviving spouse to receive everything and not have those estranged children have an interest in the deceased spouse's estate. If there's no estate plan documents in place, then lo and behold, the surviving spouse now has to share those assets with these estranged children. And this result can be easily avoided if they had just created a will. It doesn't need to be anything fancy, but without any planning done, you can run into these scenarios that are potentially very difficult to deal with for the loved ones of a deceased person.
So what about beneficiaries on, say, IRAs, 401ks, life insurance policies? How does that relate to what the estate documents might say? Or how do you, if they say different things, the life insurance policy says, pay the ex-wife, but the will and estate documents say pay the current wife, how does that work?
It could depend in that situation. Arizona does have a law that provides if ex-spouse or wife or husband is named in any sort of testamentary document, so a will, a beneficiary designation form, then that statute severs the inheritance rights of the ex-spouse unless there's some sort of divorce decree or something in place that was specifically referenced to set aside that life insurance policy, 401k, IRA, whatever it may be. But further to your point, Armando, if those documents are inconsistent, there would be a difference in what the donor or the deceased person would want to have happen with that particular IRA account versus what their will says. The beneficiary designation form will always override the will or the trust. So it's important that those two documents are consistent and that they reflect the intention and the wishes of the person who owns those particular accounts.
Yeah, that makes sense. Time goes by so quickly that people get those estate documents done, put them on a shelf, and then look at them again 20 years later. But in the meantime, 20 years of life has happened, and maybe the family is different now. Maybe the kids were minors, now they're not. Maybe there's a new spouse. All kinds of changes could take place during that time, of course. So what about, Richard, what about estate taxes? Somebody who's fortunate enough to have an estate that's above the 24 mil-ish threshold, whatever that number is these days. But when someone has an estate above that, and these estate documents that should be put together and kept current, how can the estate documents help with minimizing the estate tax for that person?
Yeah, so and the first thing is, the nice thing about the current estate tax law that didn't exist with the old law is that each person's exemption now is portable if they're married. So what that means is if on the death of the first spouse, if any of that spouse's estate tax exemption is unused, the surviving spouse can elect portability, which means they can claim any of the unused exemption of the deceased spouse. So that's where you typically get that $24 million figure between spouses. Now, what the documents can provide is the most efficient manner in which to allocate the assets upon the death of the first spouse to die. Now, if there's a number of factors to consider, but typically speaking, if that exemption amount is $24 million and they're beneath that, then the best thing would be to create a plan in which we can capture all of those assets into the estate of the surviving spouse so that the beneficiaries get a full step up in the income tax basis on the death of the surviving spouse. Now, the other thing to keep in mind too is that the exemptions are set to decrease at the end of 2025, so they will go back to the pre-Trump tax cut numbers, which would be indexed for inflation. So that might be anywhere between $7 and $8 million.
Wow.
And then, that would drastically change what might subject more people to the estate tax than with the current exemption figures.
Right. Yeah, that makes sense. So if somebody is trying to make use of the high limits today and they have a net worth above that 24 mil-ish threshold for a married couple, what might they want to talk with you about, or what conversation will you have with them so they could take advantage of part of that higher limit today versus the limit that's going to decrease in the next couple, 3 years?
Yeah, if they wanted to utilize that higher limit, then what they would have to do is basically give away that $12 million figure that they're currently entitled to. If they don't give away the full $12 million, essentially the way the law is written is it would decrease their current exemption amount at the time that they died to essentially what is ever in place. So it doesn't make much sense to just give away $5 million, because the way the math works, you won't get credit for the excess above the $8 million figure, which will be in place in a few years.
So if they want to lock in that $24 million threshold today, then a married couple, they might give away a full 12 into some kind of irrevocable trust.
If they each wanted to utilize that excess when it's set to snap back in 2026, they would have to give away the full 12. So if you don't have substantial wealth beyond that $24 million figure, it may not make sense to do, because you'd be giving away, substantially what your current holdings already are.
Yeah. Yeah. But it sounds like there are some things that can be done for that couple that's got a net worth above $30 million, and they want to make use of and lock in that exemption today. But it sounds like it'll take some conversation with you to figure out what they're really trying to get to. Often what I will hear from people is they want to make use of that exemption, but they still want to have control and retain those assets.
Yeah.
That's not always possible, but
Yeah.
But I guess it really comes down to what are they really trying to accomplish for themselves and their family.
Yep. That's the difficult cost and trade-off that you have to consider when making those gifts.
Yeah. So some of the common things that you've seen as people have, had that first conversation with you, what do you often see in that first conversation?
Well, typically we see that, they have LLCs in place. These LLCs are running a lot of their businesses. Oftentimes they may not have either a will or a trust in place. So they're coming to us wanting to create their estate plan, and then wanting assistance in making sure that their businesses are structured in a way that if they were to die, the assets of those businesses and the businesses themselves would be transferred efficiently to their loved ones and heirs.
Okay. Well, that makes sense. That makes sense. What about in estate planning, Richard? What about current income taxes? Are there things that come into play within the estate documents, or things they can and maybe should be addressed in terms of current income taxes?
I wouldn't say so much with the estate plan. So when we create an estate plan, the trust that we create is what we call a Grantor Trust. So the IRS doesn't recognize it for income tax purposes. Now, there are things that they can do with respect to their particular business entities and how those are taxed, where they could potentially save some money in income taxes. And then as far as their beneficiaries go, there's things that we want to make sure that happen if their estate is under that $12 million threshold, such that those assets are effectively included in their gross estate, so their beneficiaries get a full step up in the fair market value of the income tax basis on their death, and that they wouldn't have to pay any income taxes if they liquidated those assets shortly thereafter.
And so the step up in basis, can you expand on why that matters and what that really means? So if somebody inherits a rental house worth $500,000, what does that really mean for step up in basis on that rental house worth $500,000?
Yeah, so that's a good question. If the step up in basis refers to what figure is used when you calculate the gain when a property or an asset is sold. Okay. So if you had an asset that was worth $500,000 on the death of the owner, and that asset is part of that owner's taxable estate, that means when the beneficiaries inherit that asset, their income tax basis, so the figure that they would use to calculate gain would be 500,000, rather than the figure that the owner paid for that asset or invested in that asset over a period of time. So, for example, in your scenario, Armando, if that deceased person had only paid $100,000 for that asset, if they sold it the day before they died, they would have a $400,000 taxable gain that they would have to pay the federal government on. Now, if the beneficiary inherits that asset the day after they die, that gain is zero because of that step up in the fair market value on the asset as of the date of the death.
Yeah, a substantial difference. Yeah, thank you for that example. That makes it pretty darn clear that if there's a way to get the step up in basis on that for the beneficiary, the heirs of the person who has passed away, then it's much better for them to get that step up.
Yes.
Okay. And you mentioned a Grantor Trust a few minutes ago. A Grantor Trust versus a permanent trust or an irrevocable trust. Can you talk about the asset protection, if any, that people get when they have a Grantor Trust?
Yeah, generally speaking, Grantor Trusts don't provide any sort of asset protection based upon the powers that a grantor must retain in order for that trust to be a Grantor Trust. Now, an irrevocable trust is a trust that isn't set up to benefit the grantor, or the grantor doesn't really retain many substantive powers over that trust. So the assets placed in that particular type of trust are protected from claims against the grantor, so the trust maker, but the grantor loses control over those assets, and now they're in that trust for the benefit of whoever that grantor has designated as a beneficiary.
So a Grantor Trust, when people get estate documents done, they often leave with what's called a living will or a revocable living trust or some other words like that on the document. Those are Grantor Trusts?
A living will is not a testamentary instrument. So a living will is a document that is created by a person that says if they're in a terminal vegetative state, they want the doctor to pull the plug.
Okay.
So that's not a testamentary instrument. The typical estate planning trust that's created, you'll hear the term family trust, revocable trust, living trust. That is a Grantor Trust. So that means that the grantor typically, has the power to amend it. Yeah. It's the social security number of the grantor that's used to identify it for tax purposes. There's no filings that need to be made with respect to the trust to the IRS. It's just an extension of the person who creates the trust.
And so none of those really offer any asset protection in general?
Not to the grantor.
Yeah. So when a family gets their estate documents done, and maybe they have a revocable trust or a family trust, that they might incorrectly think that is asset protection for them and the family, but in most times that isn't at all what it's doing, right? That's
correct. It does not provide any asset protection.
Yeah.
So there's a rule against what we call a self-settled trust that most states follow. And that rule simply means that the person who creates a trust cannot fund that trust with their own assets in an attempt to defeat claims of creditors against that particular person creating the trust.
Yep, and you said the Grantor Trust are really an extension of the person. So it's still them. They still own it. They still control it. It's still them. In order for them to get any asset protection, they have to kind of cut those strings all together and put that into a whole separate irrevocable trust, right?
Well,
For asset protection.
it depends on who are you asking, who do you want that asset protection to provide? A protection for the person creating the trust?
Yeah.
So
So for a couple who comes in to you and they're looking for estate documents, they have documents 20 years old and now it's time to update them. The point I'm trying to make is that often it seems like people have a family trust or a revocable trust, and they incorrectly, inadvertently believe that that's actually providing some level of asset protection, when really what it's doing is kind of setting the stage that when they pass, when they die, that now the assets flow the way they've said they want them to flow and get to the beneficiaries whom they've indicated.
so
Is that right or no?
yeah, so I think what you're asking is there anything that can be done for the person creating the trust? Is there a type of trust that can be created to provide asset protection for the trust maker? Is that?
Yeah, really two things. You know, some of the more in a basic estate plans, as I've seen them, they often have this trust, and their personal residence goes into this trust, and the bank accounts go in there, and that's all part of the planning for the family, but it goes into some type of a revocable trust. And I think that many times people incorrectly think that that trust is providing asset protection when really it's not.
That's correct. No asset protection for the people who create the trust. Now, it can provide asset protection for the beneficiaries that they leave those assets to, because the law deems that to be a gift to those to those beneficiaries.
Yep.
That they never owned. It was given to them in a trust that they're merely the beneficiary of.
Yeah. Okay. So thank you for helping. I didn't know how to verbalize what I was trying to get you. So thank you for making that clear. Let's talk about the beneficiaries. Let's say that mom and dad come in, they set up these estate documents with you, and unexpectedly mom and dad now die. And now the kids, the beneficiaries, are receiving these assets. Is there a way that those documents can be drafted so that when the assets do get to the kids, that they are protected in a trust for the kids?
Yeah. So that would be one of the things that we would look at, if they did have documents in the past, how that gift that's being made to the kids is being made. So is it being left to them outright, which is what we don't recommend, because in that situation, it's being given to them and there is no asset protection because they own it now. So any claim that exists against that particular child is fair game to take that inheritance. Now, what we do recommend is that mom and dad leave those assets to each child in their own trust. And when the child now is eligible to receive it, it's not being given directly to them. So it's being given to them in a trust that mom and dad set up in their own family trust. And now that inheritance is protected against all sorts of claims, which include, a divorce, a bankruptcy, and any type of lawsuit. So as long as that inheritance remains in that child's trust, it's protected from anything that might happen in that child's life.
Okay.
And then additionally, that child can act as their own trustee and have control over their inheritance and use it to pay for their expenses, mortgage payments, whatever the case may be. But the important thing to stress is that as long as those assets remain in that trust, it's protected from claims that may arise against that child.
Okay. So if someone has garnished wages from something, if they get that gift outright or inherit that outright on the passing of mom and dad, then that whatever that garnishment is for could scoop away all the inheritance. But if it's in
Yep,
a trust, that doesn't happen.
correct.
Hmm.
Because the child doesn't own it. It's owned by that trust. Whereas if it's left directly to the child now becomes the owner, and it now becomes subject to lawsuits, a garnishment, whatever the case may be.
Okay. Thank you
And
for clarifying that point.
yeah, I think a lot of a big concern that a lot of clients have is with spouses and spouses of their children exercising influence or control over that inheritance.
So how do you in the documents and how do you address that? So if husband is just really exerts a lot of control and wife might not be able to, you know, to maintain family harmony in that, how do you address it in the documents so that there isn't this pressure within the marriage?
Yeah, one thing to do is possibly designate a corporate trustee to oversee that inheritance. So that way, you know, a sibling or another family member doesn't have to be the person making those decisions on what may be eligible as a distribution from that trust. Rather, they can direct their anger towards a bank or a trust company.
That's right. Let the bank be the bad guy.
Yeah. Otherwise, you know, you're looking at a sibling or a family member to act as a trustee over that inheritance, and that can create conflict, like you said, between the child with the problem spouse and, you know, their sibling or another family member or so forth. So yeah, a corporate trustee would be a good choice in that case.
Okay, that makes sense. What about special needs kids? If the parents haven't during their lifetimes created some type of a special needs trust for the kids in their estate documents, would that, with what you're describing, does that work kind of the same way that they could set up this separate trust with a corporate trustee and the beneficiary would be the special needs child who then can receive payments from that, income from that?
Yes. Yeah. So in the case of a special needs child, it's important that if they're receiving any sort of means-based government benefits, that inheritance is not left to them outright, because that would disqualify them from the government benefits that they're currently on. Mm-hmm. So the trust it needs to contain provisions that in the event that there is a beneficiary who has special needs, that beneficiary's interest will be held in what we call a special needs or supplemental needs trust. And there are some specialized rules that apply to those trusts. And, the primary thing is that the beneficiary can never act as the trustee over that inheritance. So the special needs beneficiary can't control what they inherit. The second thing is expenditures or distributions can't be made directly to the beneficiary. You know, they have to be made to the landlord if the beneficiary is renting an apartment or a house. They have to be made to the car company if the beneficiary buys a car. So there can't be expenditures that are made directly to the beneficiary. Rather, it has to be made to cover the expenses of the beneficiary and with respect to whatever is happening in that particular beneficiary's life.
Okay. Okay. what about charitable and philanthropic goals? Families often want to give gifts, sometimes during their lifetime, sometimes after their time comes. How does that fit within the estate planning as you're helping a couple walk through some of that and verbalize what they really want to have happen? Where does that fit in the estate planning process?
Yeah, so the first thing is they need to have an estate plan to make sure that those charitable gifts get made at their death. Otherwise, like I was saying earlier, it would go to whoever their intestate heirs are. So it's important that they have an estate plan that provides for those charitable gifts. Now, depending on their current charitable wishes, there are devices that can be used to give money to charity during their lifetime and possibly save on income taxes and provide benefit to the charitable donor.
Are you thinking of things like maybe a donor advised fund or a charitable lead trust, charitable remainder trust, those types of things?
Exactly.
Yeah. Yeah, a lot of vehicles that can be used during a person's lifetime where they get some kind of a tax benefit. And when I'm talking with couples about that, I prefer they do that during their lifetime typically, so they can see the benefit of their generosity and they can kind of, reap some of the rewards,
Yeah.
the happy faces and seeing the impact of what their generous dollars are doing in the community and for families and that.
Yeah, and then another thing that's nice about the donor advised funds particularly too, especially if there's money that's left in those funds after the death of the donor, is that they can use it to create charitable intentions and maybe goals within their family members by leaving them control over that fund to give to charities that they deem worthy. And it kind of gets the family a little more invested in charitable giving, and
Yeah.
otherwise might not have happened organically without it.
Right. That makes sense, where the parents can leave monies there and the adult kids, after mom and dad are gone, the adult kids need to engage and be part of that distribution process, maybe picking the charities, maybe handing the check to a charity, but somehow being engaged in that process. Richard, what about when a business owner sells and they also have, they're charitable, they want to give money to something or some kind of a cause. When the business owner sells that company and has that big payday, that's often a once in a lifetime event for them. And sometimes it happens very, very fast and they're just trying to get to the sale. And maybe they haven't had all the conversations they should have about how they could reduce some of their tax liability on that sale by using some of these same vehicles in the planning, either before the close of the sale of that business or maybe during the same calendar year of the sale of that business. Can you just touch on that a little bit?
Yeah, a charitable remainder trust could be a good vehicle to save on some of the capital gains associated with the sale of the business. The one consideration that needs to be made to the potential donor is that once those trusts are funded and the tax deduction and the gain is deferred or basically excluded within the trust because it's a charitable trust, the terms of that trust are going to dictate over that person's lifetime. So if there's annuity payment, a unit trust payment, whatever it may be, they're locked into that. So it's a good way to give money to charity and save a lot of money in income taxes. But at the same time, you got to realize when making those gifts, you are giving a little bit of something up.
Yeah, and that makes a good point that it might be more than one or two conversations with you. So I would imagine that anything that's going to get done has to get done before the end of the calendar year to be effective during that calendar year.
Exactly.
So if they're going through a sale, they don't want to wait till December 31st to call you and tell you about it.
Yeah.
Want to engage you how much sooner before they, I guess, before year end, so they don't get backed up against a wall and risk not being able to do what they really do want to do. How much lead time should they really plan with you? A couple months, 3 months, 6 months?
It just depends on the particular transaction, Armando. I'd say at least a month, but when you're selling a business, especially a business that could be substantial in value, there's a lot that goes to that, and you want to make sure that everything's properly set up and in place. So I'd say at least a month or 2 months. Yeah.
Yeah. And probably depending on, how intense is that sale. It seems that business owners, when they're selling their companies, they spend so much time with the due diligence and disclosures and all that kind of stuff that it really becomes all consuming. And if they're still trying to run the business as they're trying to sell it, then carving out some time to meet with you and talk with you and get these documents updated might take a back seat to the sale of the business. But sounds like it's not in their best interest to do that. It's worth it for them to carve out some time, have a conversation with you well in advance so that they really get what they want and what's going to benefit their family long term.
Exactly. Yeah, the sooner they can come to us, the better.
Are there any other examples or stories that come to mind, Richard, with maybe some things that were unusual that really surprised the client that you were helping when they learned something about maybe their existing documents, or maybe there was just some surprise that you were helping them to able to avert because you saw something in their documents or in their situation or in their business that you were able to address before it became a problem?
It's usually the other way around. People come to us after the problem arises and there's nothing we can do anymore. I remember a case that I had worked on a few years ago. A business owner had died and he had young children in his early 20s. I mean, they weren't minors, but they were still really young and were inheriting a bunch of money from their father, and they discovered that they had a minor who was a half brother living in another country. So at that point in time, it became very difficult to have somebody appointed as personal representative of their father's estate because he didn't have a will. And the fact that they had a minor who was heir of this estate, there was no ability to have a person waive a bond requirement on behalf of that minor, which meant to have a personal representative appointed, they would have to pay several thousands of dollars to post the bond. So long story short, this family had to have a conservatorship appointed for this minor child to waive the bond requirement and spend, tens of thousands of dollars in legal fees in order to make this happen. And it could have all been averted if their dad had created a will to designate a personal representative and waive this bond requirement. So that's one example of a story I've had after the fact where something went wrong when no planning existed, where it cost the family some money. I'd say a lot of times, a lot of our clients typically come to us when they've had a negative experience with estate planning in their own life. So they've had a bad experience with the probate of a family member, or maybe a bad experience with the trust where a wrong person was designated as trustee. And at that point in time, they don't want those issues to arise for their family members and loved ones.
Yeah. So one thing I hear about every so often is a trust protector. Can you explain what a trust protector is and why somebody might want to have one in their estate documents?
Yeah, a trust protector is a person that's authorized in the trust agreement to exercise certain powers over the trust. Now, a trust protector's powers can be very broad or very limited in scope. Trust protector is not the trustee, but some of their powers, gets kind of almost to the point where they're exercising powers that a trustee could have or maybe wouldn't have at all. So they can provide a lot of good for the beneficiaries of the trust. They can exercise powers over the trust so that it's administered in a more tax efficient perspective. They can remove a trustee if you wanted to. Now, I don't know if that's a good or a bad idea, because at that point in time, you may be acting against the wishes of the grantor or the person that created a trust. So it's important. Trust protectors can provide a great deal of good, but it's also important to realize that at the same time, they may have certain powers that go above and beyond what the grantor, the trust maker would have liked. And at that point in time, if they exceed those powers, they could create acrimony among the beneficiaries.
Yeah, that just makes me think that when people are talking with you and they have questions, they need to make sure to verbalize those questions so you can help them understand, so they can make good decisions with you on what really does make the most sense for them.
Yeah, in our trust, we do provide for the appointment of a trust protector, but we severely limit the powers they have. Primarily, they can change the governing law of the trust. So if there's a state or jurisdiction that's more friendly to administer trusts for the interests of the beneficiary, they can do that. They can change the terms of the trust so that it's more consistent with changes in the tax law, and then they can approve or reject trustee accounting. So we keep it fairly limited.
Okay. So another question that I get sometimes from a married couple who is going through the estate planning process is, on the date of first passing, do you set up a permanent irrevocable trust for half of the assets and lock that in at that point in time, or instead let the assets flow to the surviving spouse? And I'd like you to touch on that if you could, but I'd like you to keep it in the context of the kids. If this couple has a couple of children, 2 children, and then one of the, mom or dad passes away, the pros and cons of taking the overall family net worth, putting a line right down the middle and taking half those assets, putting it into a separate permanent trust for the benefit of the kids, versus not doing that and letting it flow now all to, say, mom, who is still surviving, and then when she passes, then it flows to the kids.
Yeah, so the first question in that scenario, Armando, is we want to know who those kids are. Is it a blended family? So is it, say dad died first, are those kids that he had prior to marriage with his current wife? And does dad have concerns that current wife may cut them out of the estate plan in the future? So if that's the case, then in that scenario, you definitely want to have provisions within that trust that the share for the deceased spouse is funded with their assets so that it ensures on the death of the surviving spouse, those assets pass to those children. Now, in the context of a non-blended family, so a traditional nuclear family, it's, I'm kind of torn either way. The downside in creating that irrevocable trust is that on the death of the first spouse, there's trust administration that needs to be done. You need to create the subtrust. And then additionally, it needs to have its own tax ID number. And so there is some work to do on the front end. And, in a traditional family, maybe they don't want to spend those money in legal fees to get that set up or to do that work. And then the other thing is, once it's set up, you still have some administrative tasks that you need to do. So if that's the consideration, then maybe it doesn't make sense and it's better to leave it all to just the surviving spouse in a survivor's trust. The other things that you need to consider, what about creditor claims of surviving spouse? Is surviving spouse good or bad with spending money, such that, there's the possibility that they could spend the money during their lifetime and there wouldn't be any left over for the kids if that was a wish of one of the spouses. And then finally, you do want to make sure that you don't inadvertently fund a credit shelter trust and elect some of the deceased spouse's estate tax exemption, because now you've lost the step up in basis on the death of the surviving spouse. So depending on the total value of the estate on the first spouse to die, you'd want to look at whether it makes more sense to fund a Q-tip trust that pays out income to the surviving spouse, and then what's ever left over would be inherited by the kids.
Yeah, sometimes I hear that conversation in the context of, let's say that one spouse dies and the other spouse later remarries, and the new spouse has his or her own kids from a prior relationship, and then how does that leave the kids of this first couple, who now one of them has passed, and if they want to make sure that those kids get something and that surviving spouse doesn't get swindled or anything, to that effect, that the kids don't get left out or cut out intentionally because the door was open for that to happen.
Yeah, then like I was saying earlier, in that blended family context, it's very important that separate trust gets created and funded, especially if that's a concern of one of the spouses, which is future remarriage.
Yeah, again, emphasizing that they've really got to talk with you and help you understand what is the family situation, what are their concerns, what do they want to see happen, assuming they don't live a full life to age 100, or even if they do, what happens when their time comes. Okay. And what about, are there any other things that come to mind for that business owner, Richard, who is thinking of selling, say, in the next couple of years? Again, from your estate planning perspective, and they've got a business worth millions of dollars. They intend to sell it, say, in the next, within the next 36 months. Are there concerns that you would have for them right now today that you would urge them to look at, or at least have someone look at for them?
From an estate planning perspective?
Yeah.
The primary concern is just to make sure that they have estate planning documents in place to cover them in the event that something happens to them prior to the sale of the business. So if there is an unfortunate accident, you don't want that business to get tied up in a probate scenario, where you're looking to get a personal representative appointed, where there's, the possibility that nobody currently living or thought of is in place to run that business in the interim while the things are getting settled. So yeah, those are important things to consider, at least in that particular context. I would also consider, the possibility of the changes in the estate tax law, that if, they were to die within that 36-month period, depending on the value of the business, is there sufficient liquidity within their other asset holdings to cover any potential estate tax that may exist on the value of the business.
Yeah, and that might, that might be easily resolved with getting some additional life insurance to provide that liquidity, if that becomes a problem.
Yeah, but the other thing, like I was kind of saying before, is I think it's important that they have a plan in place in the event that something happens to them. Is there a person or maybe, a key man policy, something in place that ensures that that business will continue to run at the level it did prior to the unexpected death of the owner?
Yeah. Yeah, and that makes sense, preserving the value of that company so that when that owner dies, the value doesn't suddenly begin to drop or just totally evaporates. Yeah. Yeah. Well, good. That makes a lot of sense. And anything else that we didn't touch on, Richard, that comes to mind for that family with documents that are 20 years old? Now they're coming to you saying, hey, we got to update these. Richard, how do we do this?
Yeah, I would just say, in that scenario, in 20 years, probably a lot has happened within that person's life, and the people that they thought were the best suited to care for and manage their assets and their estate after their death may have changed in that time period. They may have had older relatives that were designated who are now deceased, and for all we know, maybe nobody's named and those documents aren't good anymore. So it's likely that life circumstances have changed and those documents need to be brought up to date with the people and the terms that represent the changes in those circumstances.
Yeah. Okay, good. Well, Richard, thank you so much. If anybody listening has questions that they would like to ask you, how should they reach you? Email or phone, or what's the best way for them to reach out to you?
Yeah, the best way to reach me would be through the phone. My direct line is 480-664-7472. And you can also feel free to email me at rck@keytlaw.com.
Okay, fantastic. Richard, thank you so much for this time. Really appreciate it. I'm hoping that people will be able to listen to this and think about their own situation. And if the documents are current and up to date, fantastic. But if not, let's hope that they will reach out to you and ask you the questions they have so that you can help them get on more solid ground in case their time doesn't last as long as that they're hoping it will.
Well, thank you so much for having me, Armando. And I hope, some of the things we covered today help people out and get them thinking about doing an estate plan.
Excellent. Good. All right, Richard, well, thank you so much. Let me go ahead and we'll get together again soon and probably have another conversation like this, but thank you again.
Okay, perfect.